Let's be more specific on objective number 3. Why do we need financial information? Having reviewed the definition, let us now examine the need for financial accounting. Accounts are prepared for a variety of reasons. 1. Assess trading activities. It helps evaluate how well a business is performing in its core operations. 2. Assess manager performance. It allows external owners to review and assess how effectively managers are running the business. 3. Control business activities. It aids in monitoring and regulating various aspects of the business. 4. Future planning. It provides data needed to plan and strategize for future activities. 5. Raising finance. It is essential for acquiring additional funding or investment. 6. Reporting. It facilitates communication of business performance and activities to interested stakeholders. Now let's move to the last objective, which is objective 4. User of financial accounts. The efficiency and sustainability of a business is very important to many groups of people. These groups will have a different way of understanding of accounts. Nevertheless, attempts must be made to ensure effective communication to a broad range of users. At this stage, it is essential that we identify the main user of financial accounting. The most and foremost users are owners or shareholders. They use financial account to 1. Assess how effectively directors and managers are running the company. This is important in our businesses where the owner and shareholder are not involved in the day-to-day running, so they can rely on the financial statement to communicate the results. 2. Make informed decisions about buying, selling, or holding shares. 3. Decide on the allocation and distribution of profits. The second type of user are trade creditors or suppliers. These include the various businesses that supply goods and services to the reporting business. They are usually called suppliers. They read the financial information to 1. Assess short-term debt. Determine how much is owed and when payment are due as supplier need to obtain payment from businesses within 1 to 3 months. 2. Evaluate credit risk. Decide if they can extend credit and whether they will be paid on time. 3. Make future credit decisions. Decide whether to continue or extend credit based on the business financial health. Another category of users are long-term creditors or lenders or bankers. They are also active in using financial statements to 1. Assess asset. Determine if the business asset can be sold for cash if needed. 2. Review non-current liabilities. Check if the business have excessive long-term debt. 3. Ensure repayment ability. Confirm that interest payment and capital repayment will be made as scheduled. Employees and credit unions also use financial statements. Past employees use financial information to ensure pensions are maintained. Current employees also want to confirm job security, fair wages, and proper pension contributions by reading financial information. Trade unions use statements for wage and pension negotiations and to protect member interests. Potential employees will also be interested in assessing whether or not it would be worth seeking employment with that particular business. Customers use financial information to 1. Assess stability. They determine if the business is a reliable and secure source for goods and services. 2. Evaluate after-sales support. They want to ensure that the business can honor warranty, service, and provide ongoing support. Generally, competitors will use financial information to assess their own position compared with that of their rival business. The information will serve as a benchmark for them to use. They also want to assess takeover potential by determining the attractiveness of acquiring or merging with the business. The analyst or advisor group also use financial information. Financial journalists need information for their readers, while stockbrokers need it to advise current and potential investors. Another active user of financial accounting are governments. They want to 1. Assess tax liability. In other words, they determine the amount of tax the business must pay. 2. Monitor compliance. They want to ensure businesses adhere to reporting requirements, including revenue, salaries, expenses, and profits. 3. Inform policy decisions. They use financial data to shape and adjust future policies. Management also use financial information. In addition to the internally produced management accounts, management are also concerned with any financial statements. This is because the financial statement give an overall view of the financial situation of the business. This allows them to evaluate the performance of the business. Management would then consider the effect of such financial statements on the local community and the world at large. Lastly, the public can be taxpayers, political parties, pressure groups, and consumers. The need of this party will vary accordingly. It should be noted that in a local community, the businesses can be very important to the local economy. That's a wrap up on our introduction to accounting. The key takeaway is that accounting isn't just about numbers, it is a vital language for understanding business health. Different users use financial information for different purposes. Stay tuned for more insight as we explore accounting in greater detail. We will meet again in Double Entry System 1 in the next video. Thanks for watching. Bye bye.